Welcome to the On the Edge podcast with your host, Scott Groves. Hey, what's up, everybody? It's Scott Groves with the On the Edge podcast. I'm here with my buddy, John Mackey, and John is the owner of Credit Genius, which we'll make sure we have all the information in the show notes. I'm really excited for John because, John, this is the first episode ever where we have the official On the Edge podcast hat, which is now embroidered and super cool. So we'll send you one of these in the mail so you've got some On the Edge swag. And I know you're a heavy cigar smoker like myself, so we could talk about cigars all night. But let's start.
Oh, you know it, we can.
Let's start where you're a subject matter expert, as you are the owner of Credit Genius. And let me ask you a really easy question first. Why is credit so fucking confusing?
Because there are so many variables and we're fed so much wrong information. That's if I were to break it down into an elevator speech, that's what it would be. You've got Experian telling you one thing, you've got Equifax telling you something else, you've got TransUnion telling you something else, you get the media telling you something totally different, and then you've got yahoos like Credit Karma coming out and giving you a credit score when you don't have one credit score. You've got three, but they keep on insisting that you've got one, and they only pull from true bureaus. Now, I've got a history where we had to sue some creditors and won a lot of money because of the information that they had on there and wouldn't correct it. Now, I'm not just talking about Credit Karma.
Right.
I'm talking about the information that when my client went to get the mortgage, he was basing it on a 705 Credit Karma score. And then we pulled a bureau, a tri-merge, and he had a 610 on the Experian, and it was all about medical, but they had the wrong guy. So we're already using a lot of terms that the average consumer might gloss over their eyes. So I think it's important for us to define those. So a lot of times I'm fighting the battle with clients of like, hey, your consumer credit score, what you see on Credit Karma, or, I have one of those credit monitoring systems through Capital One credit cards, or anything that's free, basically, is going to show your, what I call, and correct me if I'm wrong, quote unquote consumer score. But then when I pull your credit report as a mortgage loan officer, it's going to be much more comprehensive, and usually the score is going to be lower. So can you explain at a fifth grade level, why are there multiple versions of the credit score floating out there between car lenders and consumers and credit card companies and mortgage people? Why in God's green earth, if this is such an important number, are there different versions of it? Why there is, I don't know. But let's just talk about the mortgage industry for a minute here. And as we were discussing prior, pre-recording or pre-taping, it's the fact that, for example, when you go and let's say you go to Experian and you say, I want to monitor my credit. So you go on there, you monitor your credit, you pull your three credit bureaus, and what they give you is a FICO 8 generic score. So it's not weighted towards any particular item. Okay, so now you take, now you go for a mortgage. Your scores are going to be different from the FICO 8 than what you get for the mortgage. Why? Because the creditors, the credit bureaus, do not, one pulls from Experian, Experian pulls from a FICO 2, for example, and I got the exact ones here. Experian uses FICO 2, Equifax uses FICO 5, and TransUnion uses FICO 4. Now, back in the 50s...
And real quick, the 2, the 5, the 4, the 8, these are all just different... these are different scoring models, right? Where these bureaus are saying, hey, Scott, you paid this bill on time, you paid this bill late. We're going to weight all these averages of, how much you're using your credit cards and how long you've been paying your payments on time. These things you're saying 3, 4, 5, 8, are these different scoring models? Are they different algorithms? Are they different companies? What does that even mean?
They're different algorithms. FICO created initially back in 95, they first came out. Prior to that, it was just conventional loans that were using FICO scores. And by prior to that, I'm talking about maybe in 90, 91 is when they started using FICO.
Got it.
Now, FICO stands for Fair Isaac Corporation. It was an algorithm developed by a gentleman by the name of Mr. Fair and Mr. Isaac. and they wanted to create a score or a number to indicate to a loan officer or to a bank what person would be liable to pay back a loan than somebody else. Who is more at risk?
Yeah.
Okay, and that would be a lower score. So they started with that. They renamed FICO 95 FICO 2. Then they come up with a new generation score and they change it to FICO 4. And then they fixed some of the kinks in that. They made it a FICO 5. Then they went to a FICO 6, then a FICO 8. Now, FICO 8 is what we're seeing out there right now as a generic. Then they changed it because there were so many complaints about credit scoring being affected by judgments, whether they were paid off or not, or medical debt. So they created FICO 9. And now just recently, they've come out with another one called FICO 10. The problem is that even though they told the public that FICO 9 fixed all these problems, nobody uses it. Okay? Anytime you pull a mortgage, it's going to be 2, 4, and 5. So as we've advanced or gotten higher in numbers, when we go from 2, 3, or 4, 5, all the way up to 10, they're getting more refinement out of it. Now, let's say you take a FICO 8. You can go and get that adjusted, weighted towards the product you're trying to buy. So they've got a different FICO for a bank card, a different FICO 8 for insurance, a different FICO score weighted for car loan. So there are a variety of ways that they weight these.
Right.
And so a credit card, for example, a credit card probably won't pull from all three. They'll pull from one, and they'll base it. And it depends upon the area of the country. Experian typically pulls from out west where you are. Nobody will know about it. They'll only pull from Equifax, and that's what they'll see. So then they give you a loan based on that.
Got it. Here's where my clients think there's some type of tomfoolery going on. Is they pull their consumer credit report and it says their credit score is 750. And then the mortgage lender goes and we pull their tri-merge report with all three of them, and we get a credit score of 745, 717, and 712. Now, usually speaking, we're going to use the middle of the three credit scores.
Correct.
And usually speaking, the difference from the consumer report and the mortgage report is not enough to really screw things up on the approval. However, as you know, because I know you worked in the mortgage industry, there's certain thresholds under or over 720, under or over 780, where it affects the rate, and sometimes it can affect the rate significantly. So here my client is seeing on their consumer report, oh, I've got a 57 credit score. I should be eligible for the best interest rate. And then I have to tell them, well, actually you got a 719, which puts you below this threshold, which means I have to give you a slightly higher interest rate. And they think we're up to no good and just trying to juice them for more money on their mortgage rate. So
it's kind of like going to buy a car. I mean, that's what they're thinking.
Right.
And in fact, it's not. You're directed and dictated by what's on the credit report.
Right.
It's as simple as that. Okay. Now, I did a snapshot one time and I took an individual with a generic, and we just pulled a credit report. But for some reason on this particular one, and I forget the brand, but it had a comparison. One snapshot, one credit report. It was off of Experian. And the variance between a FICO 8 down to a FICO 2 was 63 points.
Holy cow.
Okay. Here's the problem that I have with Credit Karma. Not only do they not give you a credit score, well, they do give you a credit score. They could give you, I had a client one time, I was talking to him and I said, what's your credit score? And he said, 995. I said, sir, that's impossible. It can't be. He said, well, Credit Karma tells me I've got one credit score. Now I'm rewording this.
Right.
So what I said, well, then how did you come up with that number? He said, I took the one number, added it to the other number, and that was my FICO score.
Ooh. Yeah, so he had like a 400 credit score.
Yeah. So I know at that point, this isn't going to work for his mortgage. So we need to go do some work. The problem is with Credit Karma also is that they don't use FICO scores, period. They used another one that nobody uses for mortgages or real estate or home loan, or car loans or cards, or some off-brand may use it,
right,
but nobody uses it. The sole purpose of Credit Karma is to sell credit cards. Right. That's it.
Yeah.
And until you realize that, if you're giving us away something, or if you're getting something for free, you're the product.
Right.
And that's what people don't realize. They're getting information. What about this Experian Boost? What a pile of crap. Okay? Where they're going to add, what they want is they want access to your bank accounts so they can strip it, find out, and they'll add minimal points to your score. Let's say 13 points, 15 points to your credit score by you adding your Netflix on it, and you're adding Amazon or whatever
you're paying monthly or whatnot.
But here's the problem. Now they've got your documentation for your bank. They got your routing, they got your account number, and they can analyze that. It's an amazing thing what's going on with the credit bureaus. I'm just amazed that more people don't understand this product.
Well, it's confusing even to me, and I've been working in the space for 21 years, and what frustrates me so much, and you know, it's funny, we don't have to go into politics, but you know where I stand. I'm pretty libertarian, pro-business, whatnot. Right. What grosses me out is that a product, aka mortgages, that is so heavily regulated by the Fair Housing Authority and has so much regulation to make sure that everybody's getting a fair shake, they pull all their data from a for-profit company. So when I pull the data from Equifax or Fair Isaac or Experian or whatever, that data is now being sold to a bunch of other lenders. You now become part of this, you know, conveyor belt of basically cold calling and telemarketing and pyramid scams and everything else. And I'm like, how is it that the most regulated product in the world, except for maybe pharmaceuticals, the most regulated product in business in the United States, which is home loans for individual borrowers, is buying all their data from these blood-sucking for-profit companies? It blows my mind. And I have no problem with a company wanting to make a profit, but the fact that the credit score has kind of been, I wouldn't call it weaponized, but maybe bastardized, where it's like you have to have access to that credit score to buy stuff in America. You have to have a good credit score in order to get a home loan in America. And they can manipulate that score however they want to try to sell you credit cards and car loans. It doesn't make a lick of sense to me. So can you maybe parse out for us like how that's all become incestual? And maybe I'm on the wrong track. Maybe you don't think there's any problems with these companies being for profit, but is there a problem? Is there a problem with the credit bureaus?
Don't take me to be a socialist. I'm not.
Right.
You know, here's the issue. You've got a variety of, where am I going here? You've got the FDCPA, you've got the FCRA, the Fair Credit Reporting Act, and you've got the Dodd-Frank Act, things of that nature that dictate how things are run. When we're talking about credit reporting agencies, and they have to give you a free credit report right now because of COVID once a week, you can get one. Okay, and that lasts until the end of April of this coming year. But before that, it was once a year. You could only get one, and they suggest you only pull one once every quarter. Well, I find that bullshit, but we won't get into that. My point is that everybody thinks that there are 3 credit bureaus, Experian, Equifax, and TransUnion. There are 40 others, 40. So in total, there are 43. They've got one for medical. Okay. Why do they have one for medical? Who's buying this information? If they're collecting it, they've got a market for it. Okay. Why is this happening? We're being watched, and everybody heard, the George Orwell book about Big Brother is watching. I'm not worried about Big Brother. I'm worried about corporate America, because they're the ones with all the information, and the government's buying it from them. Now, does that sound like a conspiracy theory? No, it's not. It's simply the truth.
Yeah.
It's a fact. And you know that, but there are very few people that don't. Debt collection is a whole nother issue, which is a topic of passion for me because of all the lies and deceit.
Yeah.
What's ironic is that I shouldn't say ironic. December 7th, I'm doing a presentation on debt collectors. December 9th, I'm doing a presentation off my website. You can sign up there on a FICO Scoring. And in this, I'll just give you tastes of everything that goes on in both of those industries. Take advantage of people's ignorance. Yeah. Tell them. I had one time I got a recording that I'm going to go over on a debt collector who told me to go F myself at the end because I challenged his authority. He said he was from a law office. He asked me if I was a lawyer, and I said no. I said I was real clear all through this conversation. I'm not. And then he asked me, "Are you a lawyer?" And I said no. I went on back to him and I said, "Are you?" And he said, "No. And I don't have to be a lawyer to practice law." Really? And that's when I said to my client, who was also on the line, "These guys are idiots." He said, "Idiots? Go F yourself."
Yeah.
Click. Okay.
Well, it's funny. This is because I deal with this all the time. I have poor clients that are trying to get a mortgage, and we're looking for letters of explanation on stuff that clearly they have no clue what it is. And, stuff comes up, right? And, sometimes in the back of my head, I'm like, these people should take care of their bills and whatnot. And maybe I'm judging in the back of my head. But just recently, so this is a funny story. I had season passes to Magic Mountain, which is a amusement park close to our house. During COVID, they shut down and they sent me an email saying hey, would you like to pause your membership, cancel your membership? The park's not open. What's your plan? I'm like, well, just cancel the membership. And if it's $5 more expensive in a year when you guys open up from COVID, I'll just reinstate it. All right. Had not thought twice about it. They've kind of half-heartedly opened. Maybe they're open. Maybe they're not open. Maybe you have to wear a mask. Maybe you don't. I'm like, I'm not going back there until the mask mandate gets lifted in California. All of a sudden, in the mail, 2 days ago, I get a collection notice for $464 from credit, blah, 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 blah. We're a collection agency. You didn't pay your membership for Magic Mountain, annual passes for you and your 2 kids, and we're taking you to collections. And it's I know what happened. It's during the rush of COVID, the left hand wasn't talking to the right hand. They let me pause or cancel my membership, but I hadn't fulfilled my 1-year obligation, and they either forgot to send me or I missed the email that said reactivate it or whatever happened. It's $400 is not a dent in my income or my net worth. I would be happy to either fight with Magic Mountain about it or send them the $400, but without any notification, they send me to collections, and now I've got this collection company calling me over $400, and I'm like, dude, I know you guys just bought the debt from Magic Mountain on 30 cents on the dollar because they want their money as soon as possible and they're hurting for cash. Magic Mountain sure as hell doesn't have a customer service department to call me, and it's now I'm stuck in this web of I've got to spend 4 or 5 hours the next couple of days figuring this all out and settling it, and then hoping that the debt collector doesn't report something negative on my credit, for something that I was not aware of, and it just drives me bonkers.
That's why you need me.
Right. I'll probably be sending you the letter.
Yeah, do that. And I'm serious, because I'll tell you exactly what to do. In fact, if you want, I'll do it myself. But we get these taken care of and negotiated all the time. I just got through negotiating with a debt collector. I'm not going to tell you not with a debt collector, but with a credit union. I'm not going to get into my techniques, right, but we're getting it off the credit report. Why? There is such misinformation. Let me give you an example. When I was doing mortgages, and when you do mortgages, sometimes, when you close on the deal, most of the time that debt is sold to the secondary market even prior to closing or at closing. Okay. Maybe it's 2 months later. Let's assume it's 2 months later. You as a consumer get a notice in the mail that says this debt from our company is now being sold to Wells Fargo, US Bank, whatever bank it is, Bank of America. You will be paying them from now on. Okay. In the credit debt collection industry, that does not happen. All of a sudden, meaning you don't get a letter from the creditor saying it's been sold or now it's being serviced by a third party. They don't tell you that. You just get a call on the telephone saying we're taking you to collections or we're collecting on behalf. Now, when they do that educationally now, I want you to know, I don't know when you had that conversation, but they have to send you what they call a done letter. And on that done letter describes all of the information that's required, who they're collecting on behalf of, whether they own the debt or are assigned the debt, the money, the interest, and so forth. And then right in the middle, in prominent lettering, it says, if you disagree with it, you've got a right to challenge this. And it says it right there. So what do? Most people say, throw it away. No, I challenge them. Everyone. Here's the thing. 5 days after that phone call, they have to send you that done letter. And if they haven't, that's lawsuit time. Now, do you take them to court for that? No, because it's a waste of your time. So what do? You challenge the debt. It's as simple as that. And then 9 times out of 10, they don't have the documentation. People don't understand how debt is bought and sold in that industry. And before, when you quoted 30 cents on the dollar, no, the average at the beginning when they make their most money is 4 cents on the dollar.
4 cents on the dollar. So yeah, Magic Mountain sold my $400 debts for supposedly what I owe them for an annual pass. They sold it for $20-$30 because they're just trying to get any money they can. And then the debt collector bought it for whatever, $20-$30, $15, and now they're trying to collect the $400 from me.
That's one way. The other way is the Magic Mountain would contract out with the debt collector, so that would be by assignment. And then this debt collector comes after you. But as soon as there is first substantive contact, meaning they make the phone call, they send you a letter, a done letter has to follow it. Now, does first substantive contact means if you see it for the first time on a credit report, is that first substantive contact? No. It's got to be a contact. In other words, they come to you and they phone you. They leave you a message. All that starts that clock. So I don't know how long ago that was.
It was a day ago. So I'll send it to you tomorrow. I'll get I got your email. I'll send it to you. But yeah. So here's the standard situation, and it's the time frame that really screws everybody up. So I'll have a mortgage client say, I'll be the bearer of bad news, of course, just another part of my job where I'm always the bearer of bad news for something that somebody else screwed up. You know this from doing mortgages in the past.
Oh, shoot me. I'm only the piano player.
Yeah, exactly. So I get the credit report and I'm like, hey, there's this weird thing where you moved from New York to LA and you probably forgot to turn in your DirecTV box or whatever. DirecTV has you on collections for $118. They call DirecTV and DirecTV says, hey, to be honest, man, we purge those records every 2 years. We probably don't even have the paperwork still to substantiate that was sent to collections. Just send us a dispute letter. We won't respond. And then after 30 days of not responding, you can get it removed from your credit report. I'm like, well, that's all fine and good, but they're under contract.
But I need it now.
Yeah, they're under contract, and I've got 15 days to lock in the interest rate. The negative credit reporting is affecting their credit score, which therefore affects their interest rate. And again, I'm just the bad guy telling the client, like, I know this is erroneous. I know you're going to have it off your credit score. I know a collection being removed from your credit report is going to boost your credit score 10, 20, 30, 50 points. And my hands are tied. I literally cannot do anything. Do you want to not buy the house or wait for the next one? And they're like, well, yep, yeah, Scott screwed me again. And I'm like, I promise you it's not me. I want to give you a lower interest rate. But what are the general timeframes? And I know there's a lot of nuance, but what are the general timeframes? Is it 30 days? Is it 60 days? What is the consumer responsible for? What is the debt collector responsible for?
When you're challenging an item off of a credit report, the law gives them 30 days to respond. Now, by respond, it has to be when they get it. That's when the time starts on their end. If you don't send it certified, you're never going to know when they got it and when they opened it.
Right.
Okay. So sending it certified will give you a time when they got it. Now they've got 30 days to investigate, and then they've got a certain amount of time to get it back to you. Okay. During my challenges that I do, I typically wait 45 to 60 days before you're going to see a response. Now, you could go directly to the creditor, challenge it there through what my company calls round 3, where we go directly to the creditor. Supposedly, they've got 15 days because they're supposed to have the documentation. And if they don't have the documentation, it's got to be removed. And if it isn't removed and it affects them in the purchase of their house, then that's an FDCPA violation. And that's exactly what happened in my case when I'm talking about that guy with the medical debt on his report. He got $80,000 because what you have to do is prove damages.
Right.
Okay. And damages would be an increase in interest rate.
Right.
Higher pricing on the home. So my guy got $80,000 for it.
Yeah.
Somewhere between $70,000 and $80,000. But what they do to mitigate damages is they will immediately take it off the credit report once you file a motion. Now you can go forward and close on the loan because it's removed from the credit report.
Right. Right. And a lot of times, what I feel bad for the client because it feels to them like I'm backing them into a corner. The sad part is the collection, the variance in the credit score rarely prevents them from the ability to buy. It just prevents them from the ability to get the best rate. And that's what's a real shame, because then I have to be the bearer of bad news of like, hey, yeah, you can buy the house, but it's going to be $100 more expensive a month. Now, in the price point
at which times 30 years.
Yeah, well, in the price point,
calculating in his head,
it's real money, and in the price point in which I play, and the fact that interest is tax deductible, the reality is for most of my clients, $100 a month is not going to make or break them, but it still sucks that they have to pay that because of some erroneous item or error in communication on what happened with a creditor, a debt collector, their credit report. It's just shitty, man. It's just shitty.
I know it is, and I deal with that stuff every day. In fact, I'm not promoting it. Well, I am promoting it.
Yeah, promote it. Promote away.
I wrote a book on debt collections. It's called Debt Collectors' Lies, Damn Lies, and Deceit.
I love it.
It talks all about the forms that are in there, the cease and desist, how to answer a motion that's brought forth by a law firm. You can tell based on how it's written whether they are fishing for an answer or if they're actually taking you to court. And all those things are kind of explained in the book. I also recommend people call me, because once you understand, and again, it goes back to this, nobody knows about credit scoring, even less know about debt collection.
Right.
And what I'm saying is that if you want the truth, and this sounds maybe horrible, and maybe my head's swelling when I'm saying this, I know it. Okay? I'm not perfect. I'm not always going to be right, but I'll always tell you the truth.
Right. Which this gets us to another point of your industry being littered with snake oil salesmen. Because I'm constantly looking up stuff on finance or mortgages or whatnot. I get all the YouTube recommended videos on stock investment, mortgages. I watch these videos sometimes, how to pay off your mortgage in 4 years. And I'm like, well, it's debt. You want to pay it off in 4 years, you have to pay extra towards your principal. It's like, this is not rocket science. And the ones that are the most egregious to me are the credit repair ones. Like for
Absolutely.
$199 a month, we'll take you from a 500 FICO to an 800 FICO in 3 months. I'm like, well, if they're doing that, it sure as hell is not legal. Because if you have a 500 credit score, there's a reason you have a 500 credit score. You've made some mistakes, you've paid some stuff late, you have some collections, and I don't care how many bank errors are on your credit report, you don't go from 500 to 800 in 3 months unless somebody's up to no good. And so what are some of the common myths that you see from people in your industry that are less scrupulous than you are?
Well, as there is a person out of Florida, kind of a young punk, and if you please call me, I'll call it to his face. He's a punk that's telling people not to pay a debt collector, even the attorney for a debt collector, because they don't have the right. You don't have the contract with them. You don't have to. You know how many visitors he has right now? 4.6 million hits off this. People are taking their advice. And the people that take his advice are getting sued.
Yeah.
Okay. But now, how does that make me or allow me to have the ability to prove to you or anybody else that what I'm saying is truth? It's by my results. It's by my truth. No one has proven me wrong on everything that I teach.
So wait, just to be clear, this guy is saying if you get a debt collection, he's saying not to employ people like you or not to respond. No, he's saying not to respond to people who send you to debt collection or that you pay late. He's just saying don't respond.
You get a call from a debt collector, tell him to go. He says, tell him to go to hell. You're not going to pay him. And there's nothing they can do. Yes, there is.
Yeah, no, there is. I've seen it. I've seen it destroy people's credit report. I've seen them taken to small claims court. I've seen them have their,
their
wages garnished. Yeah. So just ignoring
all the time.
Ignoring the problem, not a good plan. You get a big lump on your throat, go to the doctors. Like you probably have cancer.
Well, that's why I tell everybody, stand tall, get up, put your head out. But if you stand tall and you know what the truth is, it's much easier to deal with the problem. You got that lump in your throat like you're talking about, what do? You go to the doctor. If you've got an issue or a problem, you can get it taken care of. Now you don't have to worry about it anymore. You're taking care of the problem. Take care of the problem. Whether you made poor decisions, whether you lost an income, whether it was because of COVID, don't ignore it.
Right.
Because it's not going to go away.
Yeah, no, I totally agree. And, it's usually what I find, people that have lower credit, when you talk to them, because we've all made mistakes, we've all had problems, we've all had downturns in our lives. Usually when they talk to them, they're like, yeah, I got out over my skis and here's what happened. It's very rarely pure bank error or pure fraud or whatnot. Those things do happen. But generally speaking, it's like, hey, I got out over my skis. I made some bad decisions. Then there was some bad communication. And then maybe the banks did get a little too aggressive. And again, the right hand wasn't talking to the left hand, like in this example of Magic Mountain that I gave.
That's right.
But the people, I can always tell the people that are going to move forward with the loan application, because to your point, they're willing to stand tall, deal with it, accept the mistake they made, and contract somebody like you to help fix it. And then the people that are kind of snarky about it, they just disappear and they never move forward with the loan.
They didn't want to buy it. They didn't want to buy a home in the first place.
Right. They're just kicking the tires.
Or for whatever reason, I had one client just recently happened. I won't give names, but on his credit report, he had a car that now he's making minimal, not much, but he's making $800 a month car payments. And I said, what kind of interest rate are you paying on this? He said 20%.
Oh.
I said, are you serious? He said, yeah. I said, so after the first round, he went, what I told him to do is go to you belong to a credit union? Yeah. Go to your credit union and apply. And I will guarantee you almost that you're going to get a rate reduction. He did. It went down to 3%, and he saved $500 a month on his payment for his car. Absolutely crazy. But people need to be guided because we don't have information out there that's being taught on credit. Realtors don't know anything about credit. I can guarantee you that. That's why I teach for continuing education in the state of Minnesota for that. I've taught in medical schools on how to get rid of your medical debt, how to take care of that. Don't let it get behind. I teach on Udemy, Udemy. It's an online course.
Yeah, great site.
And we did one recently, end of last year, on the effects of the COVID virus on credit scoring, because you've got forbearances, you've got loans that are pushed back. I think we're going to see, and now you'll have me on tape saying this, you're going to see a lot of foreclosures that are going to be happening. I think in the Midwest here. Well, what it's like out there, I don't know.
Interesting.
But that's what I see coming up, because people aren't going to be able to afford their payments. How people are getting by right now, we're seeing an increase in credit card debt, but we're also not going to see increasing in scores. Credit scores are going to start going down.
Yeah.
Now, maybe not for the people that you service, but out in the Midwest here, there's a lot of blue collar, middle class individuals that are trying to just get an FHA loan.
Right.
So what do they need? They need a 640 mid, typically. Mm-hmm. And then they'll blame it on, there are various companies that'll go down to 580, and you had mentioned
right.
VA being one. I'm not as in touch with that, but there are some companies that make it 640 that you need, or a 620, or down to 580. Now you had, because of the COVID, interest rates increased, down payments increased as a result of the COVID virus. I just see it as a mess as we're coming out of this. There's no doubt about that. And whether you were a Republican or Democrat, and I don't care.
Yeah, it's going to be tough.
It's just reality.
Yeah. So speaking about the education piece of it, people are always asking me, well, how can I get my credit score up? How can I do this? I'm like, well, my simple understanding of the credit matrix is kind of time and service, right? The longer you have credit, the better your credit score will be. Make your payments on time and keep your debt low. So, there's all kinds of nuances in there, but can you talk about the major components, whether it's FICO 2, 4, 8, 10, whatever? Can you talk about the major components that go into, crafting a good quote unquote credit score?
Well, the first thing is a credit score is 35% of it is based on your payment history. And it affects a person more severely with a higher credit score than a lower credit score. Because a person with a lower credit score is already in difficulty, and so it doesn't affect. But let's take one with an 800, let's say a credit score over 800. You go overseas, you thought your wife was going to mail it in, she thought you were going to mail it in. Now you got a 30-day late on your credit report. How much are your score going down? In excess of 125 points. Now, if that same thing happened with a person with a 610, 605 score, it might go down 30 points. So there's a huge variance in that. And that's why, because what the credit score is trying to determine is whether or not you are in trouble or about to get into trouble.
Got it.
Okay.
So a recent late payment will devastate somebody with a great credit score.
Yes.
Got it.
By 100, and that happened. We had a guy that had an 802 credit score, mid. The credit report was 91 days old. They had to pull another one. He went down to 610.
Yeah.
How did that happen?
Oh,
I'll tell you exactly what happened.
I've been the bearer of bad news on this, where I thought I was going to cause a divorce, because same thing. We did the pre-approval 6 months ago, credit score 800, no problem. Same exact thing you're talking about. Husband thought wife was paying the target bill. Wife thought the husband was paying the target bill. Their credit score went down 80 or 90 points over like a 20-year history of perfection. Their credit score went down 80 or 90 points because the month that we were trying to close the mortgage, they had a 30-day late on their, $200 target bill or something. I was like, oh God, please don't get divorced over this silly credit snafu. We'll refinance you in 6 months when your credit score rebounds.
Well, at that point, just call the creditor and say, look, it's an honest mistake. I know you could remove this. and not make it a 30-day late? Would you do that? I've been a customer with you for so long. I've always made my online payments. I know you got access to my credit report. You can see where I'm at. So just do that. Would you do that kind thing for me? Sometimes they will.
Nice.
Okay. The second thing, the amount, no, it's not the amount. Yeah, the amount owed. And this specifically has to do with credit card debt. If you have a contractor, and I use this example, and let's say they've got a $20,000 line of credit, and during the month they're buying all their products, they're putting it on the credit cards all the way up to the max. They max out, they pay it off, they get the bill, they pay it off, and it goes down to zero. The next month they do the same thing. And all this time they're continually doing this. They are receiving a severe score hit. Why? Because what's being reported to the credit bureaus is what the bill was. So what you do now, if 5 days before the bill is due or the end date on your billing, you go online, pay it off there. Now what's being reported, your bill, is zero.
So people should be making, if people are in that situation, because I do have a lot of clients who are entrepreneurs. They run up massive credit card bills because they run their whole business through their credit, through their, to your point, I have a contractor who will frequently spend $70,000 to $150,000 in supplies over the course of a month on his Amex bill because he does major remodels in the Hollywood Hills and Beverly Hills and whatnot. So for him, because he's always paying off his Amex to zero at the end of every month, what he should be doing is he should be setting a calendar reminder 4 or 5 days before his billing statement comes out. And what's the difference? He's got the money. Go pay it off to zero 4 or 5 days before the billing statement comes out, because then the credit bureau will pick up on the fact that he's got a $200,000 Amex with a zero balance versus a $200,000 Amex with a $170,000 outstanding balance. That will help his credit score. Am I reading that right?
That is exactly right.
Awesome. That's a good tip.
That's tip number one. And I've got others, but we'll go on. Your credit history. If you've got a long credit history, it's much more beneficial that way than if you have a short credit history. Where it comes into play is when I got an email and it just flipped up on my screen here. I apologize.
No worries.
What I should do is just X out of that.
No worries.
Okay. So you got 20 years on this one credit card that you never use. Okay, maybe you use it once. It's got a $20,000 balance or limit. You never use it. I think I'm just going to cancel that. All your others are within the past 5 years. Your score is going to take a severe hit because now you've limited your history. And what they look at is the active history for the large part. Last application for credit. With Christmas coming up, you've got this big issue. And I don't know what kind of shopping you have out there, but we got Kohl's here and we've got Target. And a lot of times you go up to the counter and they say, would you like a credit card? Apply for a credit card and you get a 20% discount on your purchases.
Right.
What's going to happen? You do that 10 times over the time of Christmas, you're losing 50 points.
Right.
Because it's all revolving debt. And the coup de grace on this is that those credit card companies, number one, are not benefiting your score as much as a regular card. Number two, is backed up by a bank that's charging 30% interest. Now, how, in the name of God, with the usury laws or whatever they are, can they charge 30% interest? They can't, but they do in 2 states, and that's why they're located in these states, South Dakota and Delaware.
Yeah, all the credit card companies are in Delaware, right?
And in Sioux Falls, South Dakota.
Yeah, not surprising. So this is the one that kind of pisses me off because I'll have, like, let's say my credit score right now on the mortgage side is hovering around 760 or 740, and my consumer score is hovering around 800. what I always get as the reason if I apply for a mortgage and they send you the little letter that says this is why your credit score isn't perfect at 850, it always says, number of credit inquiries in the last 2 years. And I'm like, well, I have no debt. I have no credit card debt. Everything I've ever had has been paid on time for 22 years. And, you can't even turn on DirecTV anymore without having somebody run your credit report. And I like to get a new car every couple of years, and my wife does too. So it's like we're applying for a car loan every, 10 to 12 months on average. And then, I refinance because I got my finger on the pulse of mortgage industry. So maybe I get a new mortgage between our two house every couple of years. And then once in a while, I'll get a promotional credit card, or Amex will, do a soft pool, which I want to talk to you about that in a minute. And they'll increase my credit limit by 10 grand. I'm really proud of my credit score because it took me, 10 years of digging myself out of debt from 2007 to have my finances in order because I was dead broke about a decade ago. But the one thing that they're always harping me on is number of inquiries. It's like, what do you give a shit if I get inquiries and then I immediately pay off the debt, or I have all my payments on time? I just haven't understood with, anybody who goes to college has their credit report pulled a couple times a year for student loans. And if you move frequently and the rental agency's pulling your credit report, then DirecTV's pulling your credit report, then the gas company's pulling your credit report. Like, I don't understand why number of credit pools, all other things being equal, has such a negative impact. So can you explain that a little bit on the credit pools?
It's not as negative as you might think. It's 3 to 5 points per pull. For a credit card, they're going to do it every time you pull or an application for revolving debt.
Got it.
Okay, so you've got the soft pull and you got the hard pull.
Yeah, can you explain that? Because I think that's the most misunderstood thing. I'll have people call me and be like, "Can you do a soft pull on my credit?" And I'm like, "No, it doesn't exist in the mortgage space. Sorry."
Excuse me. Yeah, you're right. It doesn't happen there. But if you've got a credit card company that has certain standards and they want to make sure that you're continuing on with those standards, it is a soft pull. Sometimes debt collectors will do a soft pull. But the problem is that when you pull a mortgage, you're not getting an indication of what the soft pulls are coming from.
Right.
It's only through annualcreditreport.com, the official site, can you get the soft pulls. Who's looking at you without you knowing about it?
So the soft pull will be, for example, I've got an Amex business card for my coaching business. And every once in a while I'll go on Amex because it's due every month. And I'll put a little notation in there because they have this like calculator where it's like, what's the most I could charge on my credit card today? And Amex would still say yes and assume that I can pay it off every month. So I'm guessing
because of your history.
Because of my history, yeah. I'm guessing, that number's pretty high now. I'm guessing every once in a while, Amex is doing a soft pull to see if my credit's still in order. I'm not going into a massive amount of debt, but that's not negatively affecting my credit score. They're just kind of monitoring me behind the scenes to make sure that I'm not, going $200,000 into gambling debt on a credit card and I'm going to stiff them.
Yes, that's exactly right.
Okay. Now here's the other thing with credit pools, and I believe this to be factual, but maybe it's urban legend. My understanding is if I'm shopping for a car, I'm shopping for a mortgage, whatever, and I have Lexus, VW, Porsche, Toyota, Nissan, Dodge, Ford. I have them all pull my credit within 30 days. Does the credit bureau realize, oh, this guy's shopping for a car that's all one credit pool? It's not like he's trying to get 7 different car loans. Do the credit bureaus understand that?
Yes.
Thank
God. The algorithm indicates that. I mean, they take that into account. Now, whether it's 30 days, I had heard it was 2 weeks. Okay. Usually for a mortgage, it could be a month.
Okay.
Okay. On that. The problem happens is when you've got an entrepreneur that's just starting out, one of the easiest things you can get as an entrepreneur is a credit card. And what are they going to check? I had one client, he wanted to set up a smoking lounge. Okay. He had no bad credit. He had scores in the 700s, high 7s. They denied him. You know why? He had gone out to purchase a car. That one car dealer shopped his loan to 15 different places, put 15 different inquiries on that. And even though it doesn't affect your personal credit, it affects your business credit, because each one of those, you can have no more than 2 for business on the credit side, on the credit report side. And they denied him based on that.
That makes sense. That makes a lot of sense, because ironically, when I opened up the podcast business, I was like, I should get an On the Edge podcast LLC business credit card. So I went to Chase and I opened my business account, and they're like, would you like a credit card? I'm like, yeah, sure. And something must have happened with the algorithm, because usually when I apply for a credit card, they'll give me an available limit of $50,000 or $70,000 or something like that. I think my Amex is like absurd. I could go bankrupt using my Amex this month. But something had happened with the algorithm. I had probably recently bought a car or shopped for a mortgage and had my credit pulled at a couple places. And Chase came back with, congratulations, you're approved for a $2,500 credit card for On the Edge podcast. And I'm like, $2,500? I'm like, that won't even cover the cost of my camera. I'll have to split it up between 2 credit cards. So, eventually I'll go back to him and ask for a credit increase now that I've paid it off every month, several months in a row.
Right.
But it was kind of funny that like the one algorithm would say, oh yeah, give this guy $100,000 in credit card debt, no problem. And this other algorithm would be like, oh, 2,500, that's a little rough.
Well, yeah. And I've done a presentation. I did this many years ago on bootstrapping for the entrepreneurs. And it's an interesting topic. And in this day and age, when everybody's trying to not go back to work and try to start their own business, they don't know what they're doing. Because without credit, it's extremely difficult. And when you go bad on your business credit, it now transfers onto your personal credit. And it's only the derogatory that goes on your personal credit. Now, you really don't want it on your personal credit, even if it was good, because then that counts against your debt.
Right.
For a home loan.
Right.
So that's why you don't want it there. There are other reasons.
Right. But they'll definitely ding you if something goes wrong.
Oh, absolutely.
Yeah. Yeah. So let me ask you this about the credit scoring analytics. So I've had some weird situations where somebody has 3 years they've been paying their car payment on time. They're just about to buy a house, and they're like, you know what? I want to free up some cash flow. I've got the money in the bank. Let me just go pay off the last $15,000 that I owe on my car. They pay off the loan. So they're thinking like,
the score goes down.
Yeah. I got my debt down. I don't have a car payment anymore. My credit score must have gone up 40 points. I'm like, hey, sorry, dude. Bad news. Your credit score went down 40 points because you no longer have the history of paying that car loan on time. So why does that happen?
That's just the way the algorithms happen. And I believe that's more of a recent thing than anything else. And it may be more of an effect on your conventional loans than they are on your FHA loans, simply because what are FHAs now? Are they still? When I was doing business, it was 28 and 41, and then they went DU, and then it became up to 50%.
Yeah, 50%.
Some people are being approved for even over 50%.
Yeah, and the desktop underwriting, basically the automated system that we use for underwriting mortgages on FHA loans, they'll normally let you go up to 50%, which is kind of crazy because if you think where we're at on federal taxes, I don't care, whatever you believe, if you're in a state like California, some way, somehow, the federal government, the state government, depending on your income bracket, they're getting somewhere between 20 and 30% of your money. On the upper end, maybe more. But, if you figure your debt can go up to 50%, you got 20-something% going towards taxes between state and federal, that doesn't leave a lot of money left over to live.
Well,
but
that's right. Because what people don't understand is that debt to income ratio is based on your gross income.
Yeah, not net.
Yeah.
Yeah. It is weird, though, John, and maybe you experienced this when you're doing mortgages. I rarely have somebody apply for a $300,000 mortgage when they could afford $6,000. And I very rarely have a customer apply for a $600,000 mortgage apply for $1 million mortgage when they can only afford $6,000. Somehow, some way, people automatically know how to adjust their mortgage payment and therefore their loan amount. I cannot tell you how many times the debt ratio comes out at exactly 44.9%, where it's like, oh, this is just at the ratio where you can buy. Like it's weird that people can self-calculate that. I don't even have a question there. I just want to make that statement because it's very weird that people intrinsically know the absolute maximum they can spend on a house.
Right. right? Yeah, I know. But then you get those people. You had a history, not you individually, but the state of California did with negative AMs.
Yeah.
And we had communities back in Minnesota here with negative AMs. They built whole towns on spec. And then all of a sudden the housing prices hit. Now you got people in these negative AMs. Builders had to go into foreclosure because nobody could afford this debt. So they bought at 2%, and within a couple of years, it was up to 6%, with the idea that the home values were going to increase, when in fact, now they didn't.
Right.
And there was that housing bubble out there, and everything exploded. We had towns die. Now they came back. But the whole issue, mortgages, I love that business. I was at real estate. I was a real estate broker. So I owned a couple of companies. I understand the process. I understand what goes on. I don't understand what goes on in people's minds.
Yeah. I'm very happy to report because, clients ask me all the time, am I paying too much for this house? Are we in a housing bubble? Yada, yada, yada. And my answer is always three things. One, you got to have a place to live. So if you can afford the payment and you can afford the down payment, what do we care what the price of the house is worth? We care about the house the day you buy it and the day you sell it. So number one is, can you afford it? Are you comfortable? Number two is, and this gets a little bit more political, which we don't have to go that direction, but knowing that like 40% of all the dollars in the US have been printed in the last 18 months, it's like, I think we're going to have a lot of inflationary pressure that's going to keep prices high, whether that's because there's intrinsic value or that's just kind of everything's inflating in cost. And then number three, this is the part I'm actually proud about of our industry, is that, all the mortgages that have been underwritten the last 10 years, 95% of them are 30-year fixed mortgages with real down payments, with good credit scores. Like, people have skin in the game. In 2008, it was really easy to walk away from the house when you put zero money down and you had an introductory teaser rate and you didn't have to prove your income or assets. That's a much different story than somebody who put 20% down. They were properly underwritten. They've got some money in the bank. They have a real job. And it's like, they've got a little bit of a cushion if shit hits the fan, like we just dealt with COVID. So I'm pleasantly surprised in the ethics that are in our business now that didn't exist 15 years ago.
Correct. Flip that over, because you're in a market where there's a lot of money.
Right.
The values are extremely high. Incomes are high.
Right.
To afford these homes, the incomes have to be high. Well, what do you got? Let's say somebody's trying to live off of $40,000 a year and raise a family. Now, in Minneapolis, that would be very difficult to do.
Yeah.
Okay, and who are the people that are in trouble? Typically, it's people of the lower educated, lower income.
Right.
And with the strong middle class, this is where I come in with my side of the politics. If you've got a strong middle class, you've got a better buying population.
Yeah,
that can buy the goods and services. We used to be a saving society, and now we converted this all the presidents from that point forward went into a spending society.
Yeah.
Buy. Why is it we can only invest in a savings account? What is it, a 1% maybe? No,
like
not even that.
Like 0.1%.
Okay.
Funny story, John. I had a fork in my career about the mid 2000s when, so I would have been in my mid 20s. I looked young, and at Washington Mutual, where I worked for 8 years, they had this thing where they were like, okay, Scott, even if you're going to be a loan officer, we want you to get your Series 7 so that you can sell investments. We want you to know how to open a safe deposit box. We want you to open a new account. So if John comes down to sit down for a mortgage consultation, while he's there, you can roll over his 401k and you can open a checking account. Because their thought was, if John has 3 or 4 products with Washington Mutual, he's never leaving. So we were cross-trained to do everything. And at one point, I was trying to decide, do I go the mortgage route or do I go the investment route and become a financial consultant? And I remember sitting down with these clients and being like, hey, I understand that I'm a kid. I don't know what the fuck I'm talking about. I've got $10,000 in my savings account, and we're talking about your $300,000 in a CD. But please, 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 roll some of this money over to an investment or a fixed rate annuity Or, because back in the mid 2000s, you could get a fixed rate annuity that would never go below 4%. And they're like, nope, I'm sticking with my CD because I've always had CDs and my mom had CDs and my grandmother's had CDs. And I'm going to retire on that 6%, 10%, 11% rate on my CD. And Chris, maybe you can fact check this real quick. Just go to B of A or whatever and look up what a 1 year or a 5 year CD rate is. Shout out to Chris, who's always sitting in the background monitoring the stuff. So thank you, Chris. I would guess, I haven't looked at this in years. I would guess a 5 year CD or a 1 year CD, if you put $100,000 in, I would guess it's around 1%. Nobody can retire on that. That won't even cover inflation. And I was begging these people to move their money, and I was green and I was wet behind the ears and I looked like a kid, so they had no reason to listen to me. But you're right. You can't be a savings society right now because if you put your money in a savings account or a CD, you're screwed.
So what do you do with your money?
I don't know. What'd you come up with, Chris?
With a $10,000 7-month to 37-month term is 0.05 to 0.05% depending on balance and term.
So you get 0.05%.
5/100ths of a point?
5/100ths of a point on your CD.
And if you do a grand, it's 0.03.
How does a poor person get ahead? Or a middle class guy?
You can't.
You can't.
Yeah. You gotta get a second job and invest in the market or something, which is insane to me that we have shifted so much. To your point, John, you nailed it. We've shifted from a saving society to a consumer society, which is another reason why your credit score is so important, because if you're the poor dude that gets a 20% car loan and a 30% credit card, you're inherently poorer than the guy who gets a 3% car loan and a 10% credit card. I mean, that makes you hundreds of dollars poorer per month. And that poor person, poor as in mindset, not poor as in financial, the poor guy or girl who doesn't have the financial education, they're just getting screwed by the system because they don't know how to work their credit score and work these debt situations.
Right. And you still have a lot of people that are living for today rather than living for a longer period of time.
Yeah.
Living for tomorrow. I used to do child protection work also. I've done many things in my life. And I've worked in a lot of poor neighborhoods. And that's what I saw. Why did the communities drive around in these older Cadillacs or whatever? Why did they have that? Why did everybody aspire to that? Because it's something I can get now to show my wealth, to show my value, rather than thinking about, no, not going to buy this. I'm going to invest it in education. I'm going to get smart. We have lost the ability for some reason to get educated. I blame that on the curriculum. I blame that on the split up of the family. We've got men that won't take care of their children through divorce or whatever. So you got women that are living with 2 children whose husbands don't pay them or pay them minimally or whatever. It's just it's a catastrophe that's going on right now.
Yeah.
In my mind.
And I know it's politically inconvenient to talk about it, but factually, and you know this from looking at credit scores, I know it from looking at mortgages, like the 3 most devastating things you can do financially is death of a primary wage earner will devastate a family. Number 2 is divorce. And number 3 is single parenthood. Whether you like it or not, it's easier when there's 2 parents that can either work or one that can work and one that can take care of childcare. But when you've got one parent, father or mother, who's got to pay for childcare and work and try to raise a kid, it's financially devastating. And I'm not trying to get back to
doing that the rest of their life.
And I'm not trying to get back to social engineering, and I'm not trying to say that either a woman's place is in the home or that a man has to do this or anything. I'm just saying when there's 2 people, it's easier. And when people don't die, it's easier. And when you don't get divorced, it's easier. And people don't get sick. Yeah, it's easier. And it's crazy to me that we can't even have these conversations because then you're labeled something or another from either party. It doesn't matter. They're both horrible, in my humble opinion. But it's a real shame. And so coming back to the financial conversation, I'm interested in your perspective on this since you deal with credit so much. I kind of feel like there's 2 camps emerging in America when it comes to finance. There's the Dave Ramsey, have an emergency savings,
No debt.
never finance anything, never have any debt, live like a pauper today so that 10, 20, 30 years in the future, his big thing is like, live like nobody else today so you can live like nobody else in the future. It's like, okay, well, that's all and well, unless you live like you're poor until you're 50 and then you finally have some money and you end up with pancreatic cancer and you never get to enjoy any of it, which I've had some clients and relatives that have hit that. Okay. So there's the Dave Ramsey camp, live poor, never finance any debt, whatever. And then there's kind of the Kiyosaki, rich dad, poor dad of, make good investments, leverage yourself as much as you can, be knowledgeable about credit, get the lowest interest rate you can, invest in yourself, invest in your business, leverage real estate, leverage business debt, and aim for the stars and, go that direction. And I probably fall somewhere in the middle, but I feel like these two camps, the Dave Ramsey, Susie Orman versus the rich dad, poor dad, leverage, invest, buy as many assets as you can because asset appreciation and inflation will take care of you. Either as it pertains to credit or your personal opinion, having worked in real estate, mortgage, credit finance, seeing poor neighborhoods, doing loans in rich neighborhoods, do you have an opinion on which one of those camps is right?
Well, the old cop-out answer would be they're both right.
It's not a cop-out if you can explain it.
Dave Ramsey is a wonderful marketer. What he's selling is something that America can't do anymore. And that is because how do we buy things in America now? We buy it on credit. We have to. Okay, and then we pay off the credit cards. So, and the fact is that if you have no credit, like he wants, you pay, depending upon the state and the company, 5 times for insurance, what you would normally pay if you've got a great credit score. Okay, so if you've got no credit, you're paying more for your car insurance. We're being forced into using credit scoring. And why do we see so much advertisement for what is your credit score? Or all these apps that are coming out now say we can add this to your credit report. It's a collection device. Yeah, do I sound like an old curmudgeon? Yeah, I do. I just wish people would just wake up, pull their head out of the sand and other places, and start looking at things, start being educated about all this. We don't need, do we? Maybe we do, I don't know. We don't need to spend $200 for internet. We don't need, and I'm talking about people that have minimal income. But why do we need $200 cell phones? We're being sold on this. Is there a benefit there? Absolutely. Absolutely, there's a benefit there.
Right.
But at some point, we have to curb our spending. Why are we spending 30% interest for cards? Why do payday loans? They're charging up to 500%. How about the Native American gaming casinos and the interest they charge for borrowing? Where do they get their money from? I can tell you, they get them from banks.
Yeah.
So a bank, instead of being able to charge whatever the usury rate is, can now charge these places a different rate and make up the difference, or at least partial. It's a business. I mean, I'm tired of people getting rich. Let me finish that. I'm not tired of people getting rich. I love money. I want money. But on the backs of poorer people, that's what I got a problem with.
Yeah. No, it's a vicious cycle. I mean, I experienced it in the Army. The last year I was in the Army, I think I made $18,000 maybe. And around every military base, there's 100 freaking check cashing places. And there's, there's people walking the halls trying to give you 30% credit cards and whatnot. And, it's a big Ponzi scheme basically. And, you see people get caught in these traps where they're like, I saw this working at Washington Mutual in the early 2000s when I worked in a bank in a bank location that was not the most affluent area. It was nice, but it had a mix of working middle class, working poor, higher class, socioeconomic. And, you'd see people get into this trap of like overdraft charges. Their account's a couple $100 negative. Then they get their paycheck and it's like, it covers the overdraft. It covers the payday loans. It covers their 30% interest on their credit card. And then they're broke again. And the same cycle starts over. So,
I know.
Some of it I do feel bad because I feel like it's very, very, very usury. And it's a disgusting parasitic situation on our financial system. And then I also think, the libertarian in me kicks in. It's like, well, they signed the check. They signed the contract. They're just uneducated. And then the more compassionate side of me goes to like, all right, well, where do we start the education? Because, I still remember the Pythagorean theorem. I never learned in junior high or high school how to balance a checkbook or what, simple interest versus amortized interest was. Like, where do we start the education to help get that generation of people that are stuck in this trap so that the next generation doesn't get stuck in the same trap? Where do you think we should start the education?
At what age level?
Or school, or is it church, or is it nonprofits, or should Dave Ramsey be taught?
Without having credit, it would be very difficult to start talking about FICO scoring or credit reports. But I think that would be, you got to know how to balance a budget first, and if you can't, get beyond. Let's say you do that, and that should be a high school requirement, maybe even a first year college requirement. Because that's where a lot of people are getting into trouble with the credit cards.
Mm-hmm.
Now it's becoming less prevalent when they kicked them off of a lot of the campuses. But the thing, credit scoring, that's why I'm doing what I'm doing, is educating people. Can I give those plugs again?
Yeah, of course. This is your show, man.
Okay. I'm doing the one on debt collection on December 7th. And that one, you can go on our website, creditgenie.us, and you can sign up for it. On December 9th, I'm doing one on credit scoring. Because I think if people were just exposed to this, it opens eyes. And we know education is a repetitive thing.
Right.
You don't learn something in the 7th grade that's not covered again in the 8th grade, that's not covered again in the 9th grade. They just build on each other.
Right.
That's what education is. And I'm really passionate about this.
Yeah.
Why? I don't know. Maybe it's because I'm a teacher. I used to be a high school baseball coach. And I was a pitching coach. And the beauty for me, I want money. Okay. But I also like to see that light in their eye. When what I've been teaching is all of a sudden now clicking. And you see that guy on the mound and he throws that pitch and it breaks like he thought it would, like it should have, and he gives me a grin.
Yeah.
I was trying to teach my son baseball, how to hit. He came to me one time as a sidelight, but it's one of the last thoughts I'll have before I die, is when he was asking me how to hit home runs. And I said, well, I've got my theories, and if you want to, I'll teach you. Well, I tried to. And, it's a repetitive process. Until you're comfortable with it, you're never going to do it. So he gets up, we teach, and we repeat, and batting cages and soft toss and T-ball and all this stuff. And then he gets up to bat and he goes back to his old ways. What I was trying to teach him was, don't stride, already have your feet planted. So all you have to do is weight shift and hit. Finally, he did it at the fourth game. He finally did it. He hit a home run. And he came around third base and he looked at me in the dugout and he pointed to me. He says, "You don't say a thing." Okay, that year he went on to hit 18 home runs. Okay? But you got to listen. You've got to be able to trust somebody. And if there's one thing that I can get across tonight, other than educating, is trust. I'm not a shyster out here. I've been doing this a long time. There are so many shitty people doing a shitty job and taking a lot of money from people that are frauds. Don't pay a debt collector. Are you serious, Nimrod?
Yeah, pay us $500 and we'll just send out a bunch of dispute letters every month for 6 months and then leave you in a worse spot than you were already in. I've seen those guys.
Right. And I've seen the letters that are being pushed out there. You know, they go to a company. There's a new one that's just being sued by the FTC. It's a credit repair company that says, join me, meaning he wants people to join him to do credit repair business. You can make millions. That's his advertisement. So they join him. He's got a service that he offers where they send out the letters, okay? And some of these letters are the most ridiculous thing you've ever seen. You guys at the bureau are screwing up. I didn't pay this, or I was late, but I know I shouldn't have been. Well, not only did you not challenge it, you just validated it. You don't do that. I've got my ways, and I've had the information that I've got. I'm not an attorney, but I've had 6 different law firms look at what I do and how I do it. And so it's an accumulation of that. Not that I can get everything off, I can't, because if they can prove that the item is supposed to be on there,
right,
it's got to stay.
Right.
But if they can't prove it, and if you understand the debt buying process, you'd understand why they can't prove it. It's as simple as that. They're sold off of spreadsheets with no supporting documentation. I don't know if you knew that or not, but that's how debt is sold.
Right.
So Bank of America, as the hypothetical here, gets up all the debts that they can't service, or the people that are late, sell it to a debt collector off a spreadsheet with the appropriate information, but no loan documentation, no application, no nothing. So you challenge the credit or the debt collector, and they can't prove it. So what do? Pull it off your credit report, put it in another bin to sell it to another debt collector that can't collect on it either, but they're going to put it on your credit report again. That's how it goes.
It's brutal.
Yeah, it's a terrible business.
I do feel like it's gotten a little better. One of the things that used to drive me nuts is medical collections. You know, somebody would be emergency room stay, you know, where you famously get charged $37 for 2 Tylenol and whatnot, and you pay this, and then your insurance company pays this, and you missed a co-payment out of the $100,000, something happens and they send you to collections for $1,200 or whatever. My understanding is one of the good things about I think it was the Affordable Care Act or some other legislation that Obama passed. I have not seen a medical collection in forever. So my understanding is that it's either hard to file a medical collection or it no longer negatively affects your score. Is there some good news on medical collections over the last 5 or 10 years?
I'm seeing it all the time. On the reports that I'm working on, I'm seeing them all the time.
Well, that's a shame. I thought we had good news there.
No. The bad news is that there's been a study, and 47% of medical debt collection are wrongly coded. And they shouldn't have been in there in the first place. They should have been taken care of at the insurance level, but they were wrongly coded.
Got it. So probably the easiest thing to dispute then would be medical collections, because there's a good chance that it wasn't ever supposed to be on there in the first part.
Yeah.
That's good news. You know, it's funny going back to the education thing. You know, you're 2-3 years older than me, I think. Do you remember in the 80s, the DARE program, the Nancy Reagan Dare to Stay Off Drugs? And
yeah.
I almost feel like we need a national referendum from the first lady or somebody who has some clout in the political world. We need like a dare to stay off of debt, you know, where from like 6th grade to 12th grade, you get some education that culminates in like, hey, you just need to pay attention to your credit and debt, and you need to understand what interest rates are. I think it's going to take something that drastic to reshift the mentality of Americans, because I got to tell you, when I talk to clients, one of the number one reasons I have to tell people they don't qualify is because they did what they were told in high school. They went to college. They just signed all the paperwork with no clue what they were signing for. And they got
free money, right?
It's free money. And they got some sociology,
Yes.
whatever
Teaching degree.
teaching degree from USC, and they're $120,000, $140,000 in debt for something that they could have got at Pasadena City College and Cal State LA for 30 grand and maybe worked, a part-time job and paid a lot of it off. And, it breaks my heart when I meet, two teachers and they did what they were supposed to do. And they both have $55,000, $60,000 a year jobs. And, they're kind of pounding their chest like, we made it. We're making 100 grand between the two of us. And I'm like, yeah, but with your $2,400 a month student loan payments, I actually can't qualify you for a home. And it's heartbreaking that they did what they thought was right, and they went massively, massively into debt, and it didn't do them any good, because guess what? LAUSD was going to hire you, LA Unified School District was going to hire you whether you got a teaching credential from USC or Cal State LA.
That's right.
And I just don't understand why. I understand why the collection's not there, the education's not there, because there's a financial incentive for you to go $140,000 into debt. But it just breaks my heart, man. And I'm like, where is the education? Where was the person to explain to us that, like, hey, Scott, at 18 years old, you probably shouldn't get a $2,000 Circuit City credit card at 29.7% because you have to have that car stereo today.
Yeah. Is there still a Circuit City?
No, they're all gone. But
That's what I thought.
That was my very first credit card. And if I could go back in time and slap myself across the face and be like, hey, man, you're setting yourself up for 10 years of financial failure by thinking that you have to have this car radio right now in your car and finance it and get upsold on everything and then get a 30% credit card, which I did pay off. I didn't default on it, but it was just brutal. I had no education. I was ignorant. And, my parents didn't think to teach me this stuff. The school sure as hell didn't. The vendor.
Because our parents didn't have credit like we've got now.
Right. Good point. So, yeah, more education. My
dad never had a credit card. He paid his VA loan off in 7 years.
Good for him, man.
On one income.
Amazing.
And he was a blue-collar guy.
Amazing.
Talk about a penny pincher.
He was a Dave Ramsey soldier.
Oh, he could have taught Dave Ramsey. I mean, literally anything he spent, he had a receipt for it, and it went on the ledger that same day.
Yeah. Yeah, I believe it. And, there was probably another thing. I would guess your father probably drove his car until it was in the ground. He probably wore the same watch until the thing just couldn't be fixed anymore. He wasn't going out, what we have now, which is basically designed obsolescence, where every year I've got to buy a new $1,300 iPhone if I want the thing to work properly. It's like there's a generational difference where it's like I just use the thing until it breaks or it wears out versus, and I'm guilty of this, like, of course I need to have those new Nike shoes in 4 different colors. It's like, no, I should buy one pair of shoes and wear it until it wears out, not till I get bored of it. But there's a generational gap where, to your earlier point, we've become these massive consumers.
Absolutely. And then the product that's being made isn't even made in this country.
Right.
Which is the other problem. So now we're losing jobs. I mean, it's a conundrum, and it's a major issue.
Yeah.
For me anyway. But yeah, I mean, my dad had one credit card. He worked for Northwest Airlines. The credit card he got begrudgingly because when he flew, he needed a credit card to rent a car. And that's the only reason he got a credit card. He never borrowed money for anything else. He bought his first new car when he was 60.
Wow.
Everything else, I was born in 53. He would take me around in a 10-year-old car and he worked on his own car. Okay, so he could fix it. He could do all the oil changes. He could do the points, condensers, all that stuff. But we lived very frugally. Did I know I was living frugally? Or in other words, was I a skinny guy with scurvy because he couldn't afford to feed us? No, not at all. But there were limits. But we don't live that way anymore.
Yeah.
We lived in a spending society, for good or for bad.
Yeah.
And the credit cards, I think, are the biggest scourge in this in America right now.
They're brutal.
And we're seeing debt going up and up and up and up and up, and credit card balances going up and up and up and up.
Absolutely brutal. So I always like to end with a couple questions, hopefully a positive note. What's the question I forgot to ask you? I don't care whether it's personal, whether it's credit related, whether it's something we need to know about credit. What's the question I forgot to ask you where you're like, oh man, I wish we would have hit on this topic because this is a good one.
How to build credit. That's not a big one. There are appropriate ways to do it, and then there are less appropriate ways. I think everything I've hit off of this.
Cool.
If you wanted to go off on tangents about smoking cigars and the benefits to health by doing so, people may look at me and think I'm 68. I'm not. I'm 94. It's all because of smoking.
Right.
Is that old George? What's his name? George. What did your doctor say about your smoking? Do you remember that old comedian George Burns?
George Burns, yeah, always had a cigar in his mouth.
Yeah, he said, "What did your doctor say about your smoking?" I don't know. They're dead.
Yeah, yeah. He did a movie. Oh, you're gonna have to look this up, Chris. It's George Burns. I think it's called "Oh God, My Devil" or "My Devil, Oh God" or something like that, where he plays God and he plays the devil. And I just remember as a kid watching that George Burns movie with my grandma, and it seemed like such adult content. I'll have to go back and watch it at some point.
It's just called Oh God.
Oh God. Okay, it's called Oh God.
Yeah.
And I'm gonna have to go back and watch it to see if it holds up, because I remember watching that with my grandmother and feeling so adult, like, oh, I'm watching this movie that has like religious concepts, and this guy always smokes a cigar, and they're talking about adult stuff. So I'm gonna have to go back and watch that, because I remember when he passed, my grandmother and my dad were really sad, because they loved his comedic shtick, and they loved the fact that here's this 120 pound tiny man always with a big Churchill cigar in his mouth. It was kind of funny. And then, last question, because we could get off on a cigar tangent and talk for another 2 hours.
But I was just teasing.
I know. When it comes to, coming out of the lockdowns, the pandemic, the craziness, whatever you want to call it, what are you looking forward to, or you're, kind of getting back to normal? Because I think in Minnesota there, you guys have been pretty locked down, as we have been in California. What are you looking forward to getting back to?
Normalcy, whatever that is. I want to be able to not have to talk about the pandemic.
Right.
I want to not have to worry about, am I going to catch something? I'm, because of my age, number one, because of other things that I have, I'm immune compromised. So I've had COVID. My wife had COVID. My son had COVID. Apparently we were healthy enough to move on from it. What I would like to see, in all honesty, I'd love to see a united America. I would like to see, even though we've got disagreements, you're not an asshole for believing one way, and I'm not an asshole for believing another, or to want to kill somebody because of their belief system. I want to be more gentle with who people are, because people come from experiences and where they came from and where they grew up. How we got on this, I don't know, but we've become so polarized. Not that we're not going to have disagreements.
Right.
But I just remember the good old days, however long ago they were, when you could fight, call somebody whatever and say they were a bad person. But then you go have a cigar in these smoke-filled rooms and you hash it out.
Yeah.
Come to a compromise. Right now, there's no compromise on either side.
Yeah. And again, you get a couple of years on me, but I do remember, even as recently as the late 80s, early 90s, going on Boy Scout trips where we had fathers that disagreed venomously on politics. I mean, venomously disagreed on politics. And sitting around the campfire, we would have really, really heated debates, and that's probably where my passion for politics came as a preteen or a teenager, seeing people that I respected really go at it on politics. And once in a while, somebody would get huffy and walk away pissed off. But you know what? The next morning, we were breaking down camp together, hiking 10 miles together, doing, communing, or, there was a camaraderie there. And it was like, yeah, I might disagree with you venomously, but doesn't mean you're a bad person. Let's move on and do what's best for the kids and do the Boy Scout thing and do the camping thing. And it was great. And, some of my best friends are children of people who I disagree with venomously about politics, and I love them all. And I don't know what changed that we got away from that, but I agree with you. I hope we can get back to something a little bit more normal and a little bit less divided.
Yeah, absolutely. Absolutely. Thank you very much for allowing me to rant and rave about credit scoring and
I really appreciate it, John. We're going to put all of your information on our website for mortgage stuff. We'll also make sure we have all your contact information to put in the show notes. We'll blast this out to our database. And I think we're doing this series on YouTube in addition to the podcast called Mortgage Mysteries. And I think we're going to break down a couple of these pieces about, the inquiries and what affects your credit score, and also release it on our mortgage channel because it's so relevant to clients that are trying to clean up their credit and, kind of get the best rate or take care of their mortgage. So thanks for being on and being a wealth of knowledge. And I'm sure we'll get some clients your way here shortly, sir.
Well, I appreciate that, but also get the education out there. One quick question. Do you know when this is going to be broadcast? Because I want to make sure, because I mentioned the December 7th, the December 9th.
Yeah, this will probably come out the first Thursday of December. So what is that, Chris? We might even be able to get up this Thursday. We're not going to release one on Thanksgiving. We usually release on...
the first week of December would be fantastic.
Okay, cool. So we'll get it up the first week of December.
Yeah.
All right, man.
Like that. You said the first Thursday.
Yeah.
I'll figure it out when it is.
Yeah. And
that would be the 2nd?
Yeah, the 2nd. So we'll get it out December 2nd, and then we'll send you all the clips so you can share on your social media or send out to your database.
Beautiful. You've been great.
All right, man. Hey, John, thanks for being here. Next time you're in Los Angeles or Vegas for whatever reason, let me know so we can go have a cigar. All right. Talk soon.
You, man.
Bye.
Bye.